April 2nd, 2025, will always be remembered as the day when American industry got a fresh start. The day America's path was brought back on track, and the day we began making the country strong and successful again. It may have taken much longer than expected and cost billions more than planned, but oil is finally flowing through the expanded Trans Mountain Pipeline, a project the Canadian federal government took over back in 2018. Right now, the new Canadian Prime Minister, Mark Carney, is responding to President Trump's new tariffs. Here's what he just said about it. A massive pipeline, which had been in the works for decades, has now reached the Pacific coast from Canada's oil-rich heartland, opening the door to huge Asian markets like a vault that had been locked for years. The Trans Mountain Pipeline expansion, a $34 billion project, was launched in May 2024 and is set to reshape Canada's energy future. For years, the U.S. had a tight grip on 98% of Canada's crude exports, but now things are changing. Just as oil started flowing, a major announcement shook the market. Donald Trump, eyeing a comeback to the White House, threatened to add a 10% tariff on Canadian oil and gas, putting a big part of Canada's economy in danger. It seemed like trouble was around the corner, until a surprising move changed everything. China's Rangshan Prochemical, a giant in refining with a huge need for crude oil, saw an opportunity. Like a skilled chess player, the company made a bold move into Calgary, Alberta's oil hub, and signed a deal with Suncor Energy, one of Canada's top producers. This deal locks in oil shipments from the new Pacific port starting in June 2025. What looks like a quiet business deal could actually be the first sign of a major global energy shift. Canada is now showing it can play a bigger role far beyond its borders. The world is watching closely because the game is just getting started. Yesterday marked another bold move in President Trump's string of aggressive tariffs, which are shaking up the global trade system. Rangshan's entry into North America is a big deal. The company, a part of Zhejiang Rangshan Holding Group, runs one of the biggest refineries in China and has a large appetite for heavy crude, the exact type Canada's oil sands produce. According to Reuters, Rangshan's new office in downtown Calgary is focused on securing long-term supply chains as China works to reduce its reliance on Middle Eastern oil due to rising global tensions. Their first big move is a long-term contract with Suncor to send 200,000 barrels each month from Burnaby to China. Bloomberg reported that the first shipments are already booked on large crude tankers, and Rangshan isn't stopping there. Sources told the Globe and Mail that the company is also in talks with other major energy players in Alberta like Cenovus Energy, which produced 800,000 barrels a day in 2024, as well as Canadian Natural Resources Limited. Rangshan is even speaking with international companies like BP and Shell, both of which have strong stakes in Canada's oil sands. These deals are being done under free-on-board FOB terms, which is a clever strategy. It means Rangshan controls the oil once it's loaded onto tankers, giving them the freedom to sell it to buyers in Japan or India if those markets offer better prices. According to S&P Global, this flexibility could add an extra $2 to $3 in profit per barrel thanks to changing prices. This is a major milestone. Canada has waited for this kind of opportunity for a long time. Building big pipelines isn't easy, and while the Trans Mountain expansion was expensive and delayed, it finally gives Canadian oil access to new global markets, something long overdue for one of the world's biggest oil producers. Leading Rangshan's Canadian operations is Wang Jia, a seasoned oil executive with over 20 years of experience. He previously set up PetroChina's Canadian trading branch back in the 2000s. With his connections and strong deal-making skills, Wang is helping Rangshan navigate its entry into Canada's oil industry. The company plans to secure 10% of the Trans Mountain expansion's capacity by 2026, according to people familiar with the strategy. The Trans Mountain expansion, often called TMX, is key to all this. It tripled the original pipeline's capacity to 890,000 barrels per day, enough to fill about 50 Olympic-sized swimming pools daily. TMX began operations on May 1, 2024, after years of legal challenges and cost increases. The original cost was projected at $7.4 billion, but it ballooned to over $34 billion, as reported by CBC News. Since Canada bought the project from Kinder Morgan for $4.5 billion in 2018, it has faced strong opposition. Environmental groups warned about the risk of oil spills in the Salish Sea, and indigenous communities like the Tsleil-Waututh Nation filed lawsuits saying they weren't properly consulted. Construction was delayed until Canada's Supreme Court cleared the project in 2022. Now, with 20 new storage tanks and a modernized marine terminal at Westridge, TMX is finally linking Alberta's landlocked oil with Asia's refineries. These refineries value Canada's heavy sour crude, because it works well with their complex refining systems. The International Energy Agency says that for decades, Canada's 3.8 million daily barrels of oil exports mostly went to refineries on the U.S. Gulf Coast and Midwest. These barrels were often sold at a discount, sometimes $15 less per barrel because of pipeline limits. TMX changes that. In fact, the first shipments already arrived at South Korea's U.S Caltex refinery in August 2024, according to tanker tracking data from Kepler. The Canadian government sees this as a potential $20 billion annual boost to the economy. Still, some critics say that just one oil spill could do severe damage to British Columbia's coastline. To address this, the government created a $1.5 billion spill response fund. Trump's tariff threat has sparked a renewed push in Canada to diversify its energy exports. In 2023, Canada sent $200 billion worth of energy to the U.S., according to Statistics Canada. But a 10% tariff could cause Canadian producers to lose around $10 billion a year in profits. The Canadian Association of Petroleum Producers warned that U.S. refineries, which use 3.9 million barrels of Canadian crude every day, could end up paying more. Analysts at Goldman Sachs say American gas prices might go up by 80 cents per gallon, which could be a major problem during election season. Canada didn't just sit and watch. In June 2024, Prime Minister Justin Trudeau launched a $6.5 billion Global Markets Accelerator program. This includes $5 billion to help oil and gas companies reach Asian markets and $1 billion to help farmers hurt by U.S. trade disputes. The energy industry responded fast. Suncor's deal with Rangsheng was signed just a few weeks later. Natural gas is also becoming a key part of this shift. LNG Canada, a $40 billion project based in Kitimat, British Columbia, is led by Shell and ProChina. It's expected to start exporting 14 million tons of liquefied natural gas per year beginning in late 2025. It's aiming at fast-growing markets like Japan and China, where demand for gas has been rising by 8% per year, according to the International Energy Agency. Conservative leader Pierre Poilievre is pushing to revive the Energy East pipeline, which would bring oil to eastern Canada and Europe. At the same time, Trudeau's government is looking at Arctic routes to export LNG to Germany. Canada's energy focus is shifting quickly away from its long-standing dependence on the U.S. and turning toward Asia's massive $15 trillion energy market. As Canada's shift toward Asia speeds up, North America's deep energy ties are beginning to loosen. The U.S., which relies on Canada for 60% of its crude imports, could face tough challenges ahead. The tariffs might backfire, encouraging Canada to send more oil to China, which already increased its Canadian imports to 184.0 barrels per day in 2024, a 22% jump from the year before, based on China's customs data. U.S. refineries may need to turn to more costly oil from places like Saudi Arabia or Venezuela, which could add $5 to $10 more per barrel, say analysts from Wood Mackenzie. Even with political tensions between Canada and China over issues like Huawei and canola, oil remains too important for both sides to ignore. Bloomberg notes that crude oil is too vital to be hit by sanctions. With TMX now operational and LNG Canada preparing for its first shipment, Canada's rise as a global energy force is already underway. Alberta Premier Danielle Smith called this the start of joint energy independence in a speech last September and predicted $500 billion in export revenues by 2035. Though oil is the main story, natural gas and hydroelectric power are playing key roles too. LNG Canada's first delivery, expected in December 2025, will send 2 million tons of gas to Asia, with ProChina owning a 15% stake, according to Reuters. Currently, all of Canada's daily natural gas exports go to the U.S., but that's about to change. New LNG routes to the Atlantic and Arctic are opening, and by 2027, Canada hopes to supply gas to Europe, which is still looking to move away from Russian energy. In 2024, Hydro-Quebec and Ontario Power Generation exported 42 terawatt-hours of electricity to the U.S., enough to power about 4 million homes and bringing in $2 billion, according to Natural Resources Canada. Together, oil, natural gas, and hydropower are turning Canada into a strong and flexible energy superpower, now aiming at Asia's fast-growing economy instead of depending mainly on the U.S. Canada's energy map is being redrawn, and it's a high-stakes shift. Rangsheng's bold step into Calgary, the steady oil flow through TMX, and the global push of LNG Canada are not just small changes. They're the start of a big break from U.S. energy control. For many years, the U.S. used nearly all of Canada's oil exports. But now, things are changing fast.